Imagine this. You're 72 years old. Your alarm clock doesn't wake you for work anymore. It wakes you for medication. Your house is paid off. Your career is behind you. You did everything right. And yet, your bank balance is almost empty. No paycheck is coming. Your savings are shrinking. Every month, inflation is quietly raising prices. And suddenly you realize something terrifying. You didn't run out of time. You ran out of money. This is the retirement nightmare nobody likes to talk about. We're taught to fear dying too young. But what if the real danger is living too long financially? What happens when your savings hit zero? Who pays your bills? Who covers your healthcare? And what if the system you trusted was never designed to support you for decades of retirement? Because here's the uncomfortable truth. For millions of people, retirement is no longer a finish line. It's a financial survival test. And the scariest part, most people don't even realize they ran on this path until it is too late. Today, we're uncovering what really happens when you outlive your money, how we got here, why this crisis is accelerating, and what the warning signs look like before everything breaks. But to understand the future, we must first rewind, because this problem didn't start with individuals, it started with a promise. After World War II, something revolutionary happened. Governments, corporations, and banks created what was sold as the ultimate safety net, the modern retirement system. Pensions promised guaranteed income for life. Social security programs promised government support. Savings accounts offered stability. Housing prices climbed steadily. Economic growth expanded year after year, for the first time in history. Ordinary workers were told, work hard for 40 years, and you'll be taken care of forever. This idea created the retirement dream. People planned for 10 or 15 years of retirement. Life expectancy was shorter. Healthcare costs were lower. Inflation was manageable. Families often supported older relatives, on paper. The math worked, but something changed. Quietly, slowly, almost invisibly, people started living longer, much longer. Medical breakthroughs extended life expectancy by decades. At the same time, pensions disappeared. Companies shifted responsibility onto individuals. Governments accumulated massive debt. Inflation began eroding purchasing power, and suddenly, the system designed for short retirements was being asked to fund long lives. The foundation was cracking, but most people didn't notice, because during the early years, everything still looked stable, until the pressure began building. Let's talk about the core problem. Retirement systems depend on one simple assumption: more workers paying in than retirees taking out. But demographics flipped that equation. Birth rates dropped, populations aged, fewer young workers entered the labor force, more retirees depended on government support. At the same time, employers quietly removed pension guarantees instead of lifetime income. Workers were given 401(k)s, personal savings accounts, investment portfolios, self-managed retirement plans. The S shifted the risk from corporations to individuals. Now you are responsible for market crashes, inflation, longevity risk, healthcare costs, investment mistakes. One bad decade in the stock market could destroy decades of savings. And then came the silent killer: inflation. Even low inflation quietly destroys purchasing power. What cost $1,000 per month today may cost $2,000 in 20 years. But most retirement plans don't double, they shrink. So while people believed they were building security, the real value of their money was being slowly drained. The seeds of the crisis were planted. And then the illusion of safety made it worse. For decades, markets went up, housing prices exploded, stocks soared, credit became easy, debt was normalized, retirement accounts looked healthy on paper. People saw their balances grow and thought, I'm fine, I'll retire comfortably. Financial advisors promoted optimistic projections, governments reassured citizens, banks sold long-term investment products. But these projections relied on perfect conditions: consistent market growth, stable inflation, no major economic shocks, no healthcare emergencies, no long recessions. Reality doesn't work that way. And while portfolios grew, expenses grew faster. Healthcare costs surged, housing became more expensive, energy prices rose, taxes increased, insurance premiums climbed. The average retiree now spends far more than retirees from previous generations, Yet most savings plans were built using outdated assumptions. The gap widened, but still, most people didn't panic. Why? Because withdrawals hadn't started yet. The danger only becomes real once the paycheck stops. Ritter. It meant it's not just a lifestyle change, it's a financial shock. One day you receive regular income. The next day, it disappears. Now your savings must replace your salary. Every grocery bill now comes from your future. Every medical expense eats into your safety buffer. Every market downturn permanently damages your portfolio. This is where the math becomes brutal. Withdraw too much, and your money runs out early. Withdraw too little, and your quality of life collapses. And the market doesn't care that you're retired. If stocks crash in your first 5 years of retirement, your portfolio may never recover. This is called sequence risk. Bad timing destroys retirement plans. Many retirees experience something even worse: unexpected costs, a single hospital stay, a long-term care event, a family emergency, a home repair, a spike in rent or property taxes. These expenses force people to withdraw more, accelerating the collapse. And here's the cruelest twist: the longer you live, the higher the risk becomes. You need more money the longer you survive. Longevity becomes a financial liability. And slowly, quietly, balances begin shrinking faster than expected. At first, it's manageable, then it becomes uncomfortable, then it becomes dangerous. And finally, it becomes irreversible. This is the stage most retirees fear. Checking account balances drop, investment statements show smaller numbers, monthly budgets become tighter. Choices become painful. Do I buy medicine or groceries? Do I turn on heating or save electricity? Do I help my family or protect myself? Psychological stress skyrockets. Many retirees return to work, not for purpose, but survival. Others sell assets, downsize homes, cut basic necessities, delay medical care. And still, the money keeps shrinking, because inflation never stops, healthcare never gets cheaper, and aging never reverses. At this stage, people realize something terrifying. They planned for retirement, but they didn't plan for longevity. They prepared to stop working. They didn't prepare to fund decades of living without income. And this is where the real crisis begins. Because when savings finally reach zero, there is no reset button. There is a moment most people never imagine. It's not dramatic. There's no explosion. No headline. No alarm. It's just a number on a screen. Zero. That's when reality truly begins. When savings disappear, retirees enter a completely different world. Bills don't stop, rent doesn't pause, food still costs money, healthcare still demands payment. But income is gone. At this stage, people rely on whatever safety nets remain: government pensions, social security payments, family support, charity programs, community aid. And here's the hard truth: for most people, these safety nets were never designed to provide comfort. They were designed to prevent starvation. Monthly government payments often barely cover basic living costs. Healthcare systems become overloaded. Waiting lists grow. Quality of care declines. People who once lived independently now depend on others for survival. The psychological impact is devastating: loss of dignity, loss of autonomy, loss of control. And the emotional toll spreads to families. Adult children suddenly become financial caregivers. Grandparents move into small apartments or spare rooms. Entire households are forced to support aging relatives. This isn't rare. It's becoming normal. And this is where the retirement myth finally collapses. When millions of people outlive their money, the damage doesn't stay personal. It becomes systemic. Healthcare systems get overwhelmed by aging populations with limited resources. Government budgets strain under rising pension obligations. Tax pressure increases on younger workers. Public debt grows. Younger generations begin paying more, while receiving less in the future. This creates intergenerational tension. Workers feel exploited. Retirees feel abandoned. Governments struggle to balance promises with reality, and the economy feels the shock. Retirees cut spending. Consumer demand weakens. Local businesses lose customers. Economic growth slows. At the same time, financial markets experience increased volatility as retirees are forced to sell assets during downturns. This creates a feedback loop. Market drops gives retirees sell gives prices fall further gives savings shrink. Faster, it's a slow motion collapse. Not loud, not fast, but deeply destructive. Governments and institutions have tried to patch the problem, but most solutions are short-term bandages on long-term wounds. Raising retirement age. One popular solution is simple: just work longer, but this ignores reality. Many people in physical jobs can't work into their late 60s or 70s. Health problems increase with age. Age discrimination limits employment opportunities. Working longer delays the problem, it doesn't solve it. Cutting benefits. Another approach is reducing pension payments. This saves government money, but it pushes retirees closer to poverty. It transfers risk downward. Instead of fixing the system, encouraging personal investing, people are told, invest more, save more, plan better. But wages have stagnated. Living costs have risen. Debt levels are high. You can't save what you don't have. And even disciplined savers are exposed to market crashes, inflation, and healthcare emergencies. Relying on economic growth, some hope the economy will grow fast enough to solve the problem, but growth is slowing in many countries. Aging populations reduce productivity. Debt burdens increase. Global instability rises. The math doesn't improve, it worsens. Which brings us to today. This isn't a future problem, it's happening right now, across the world. Millions of retirees are already struggling. People returning to work after retirement, elderly workers doing delivery jobs, grandparents driving ride-share cars, seniors working retail shifts. Not for purpose, for survival. Meanwhile, inflation quietly steals purchasing power. What bought groceries 5 years ago now barely covers basics. Healthcare costs continue climbing faster than inflation. Housing costs remain high, and interest rate changes impact savings accounts, investments, and debt. Here's the shocking pattern. Every generation is being told the same story. Save more, work harder, trust the system, and every generation is discovering the same outcome. The system was never built for mass longevity. It was built for shorter lives. Longer retirements expose structural weakness, and the longer people live, the more pressure the system faces. The most dangerous phase isn't running out of money, it's thinking you never will. False security delays action. People underestimate inflation, healthcare costs, longevity, market risk, economic instability. They overestimate investment returns, government reliability, pension stability. Employer promises. This creates fragile retirement plans. They look strong until stress hits. And when it breaks, there is no recovery phase, because you can't earn back lost decades. Time becomes your biggest enemy. Now comes the most important part, because this story isn't meant to create fear, it's meant to create awareness. Here are 3 lessons everyone must understand. Stopping work doesn't mean you're financially free. It means your assets must replace your income. True retirement security isn't about hitting 60 or 65, it's about sustainable cash flow. If your money can't support your lifestyle indefinitely, you're not retired. You're unemployed with savings. Most people plan for market crashes. Few plan for living 30 years without income. Living longer is a blessing, but financially, it's a liability if unprepared. Every extra year adds cost. Every decade multiplies risk. Ignoring longevity risk is one of the biggest mistakes people make. Governments change rules. Pensions get cut. Inflation rises. Markets fluctuate. No system guarantees comfort. Financial survival increasingly depends on personal strategy, multiple income streams, inflation protection, cash flow planning, expense control. Long-term thinking. Waiting for institutions to protect you is no longer realistic. Here's the uncomfortable truth. The retirement crisis won't arrive with sirens. It won't make global headlines. It will happen quietly, one household at a time, one bank account at a time, one elderly worker at a time. People won't say, I outlived my money. They'll say, I'm just cutting back. I'm working part-time. I'm helping family. I'm managing. Until one day, there's nothing left to manage. And by then, the choices are gone. So here's the question that matters. Will you design your future, or inherit the system's failure? Will you depend on promises or build resilience? Will retirement be freedom or delayed poverty? Because the decisions made today determine whether old age becomes security or survival. If this video changed the way you think about retirement, money, and long-term planning, like this video to support financial education. Subscribe for more deep financial breakdowns. Share this with someone who still believes retirement automatically means safety, and comment below. Do you think modern retirement systems are sustainable, or are we heading toward a global retirement crisis? Your answer might shape someone's future.